And the US dollar is in trouble. It has just posted its worst first half performance in more than 50 years, triggering alarm bells in global markets. So what's really driving this historic slump, and what does it mean for global markets? The US dollar index has slumped 10.8% in the first 6 months of 2025, and that's...
The dollar isn't just slipping, it's unraveling. China's new gold contracts in Hong Kong and Trump's aggressive Fed plans are redrawing the global economy. While Wall Street watches interest rates, the real power moves are happening in Beijing, Tehran, and Hong Kong. This is economic warfare. And America? It's on the defensive, the end of dollar stability. The dollar was never invincible, but for decades, it acted like it. It powered empires, backed military campaigns, and settled 80% of global trade transactions. But today, that number is falling fast, from 82% in 2009 to just 43% in 2025. The world isn't ditching the dollar all at once, but they're detaching from it with purpose, slowly, systematically. This isn't speculation, it's policy, especially in China. Behind closed doors, China has been pushing a quiet campaign to dethrone the US dollar. It's doing this not with bombs, but with bullion. In May, China announced it was expanding its Shanghai Gold Exchange to Hong Kong, launching 2 new physical gold contracts outside of mainland jurisdiction. That changes everything. Hong Kong is still considered an open global financial hub, and China's offering physical gold real metal, not paper for trade and settlement. Investors who once relied on London's LBMA, which moves around $140 billion monthly, now have another option, one that doesn't pass through Western regulatory hands. China's strategy is crystal clear. Shift trade away from dollar-denominated systems and into hard assets and yuan-backed alternatives. And the moment they announced their Hong Kong bullion expansion, markets took notice. In May alone, the Shanghai gold market hit $10.5 billion in volume, a fraction of London's scale. Yes, but it's just the beginning. Trump's Fed shakeup. While China builds long-term, Trump moves fast and loud. At the NATO summit in Brussels, Trump quietly shortlisted 3 candidates to replace Jerome Powell as Federal Reserve Chair. The signal? Interest rate cuts are coming, whether Powell likes it or not. For months, Trump has blasted Powell, accusing him of keeping rates too high and choking the economy. Inflation may still be sticky, but Trump wants looser policy, and now he's preparing to install someone who will deliver it. Why does this matter? Because cutting rates makes US assets less attractive to global investors. Lower yields on treasury bonds, weaker returns on dollar-denominated securities. It all adds up to one thing: less demand for the dollar. And with that, America's ability to fund its ballooning deficits becomes even more fragile. The US needs to borrow billions just to keep the lights on. If fewer countries want to hold treasuries, rates rise, or worse, the dollar crashes. That's not hyperbole, it's happening now. Tariffs, trade war, and the collapsing export engine. Trump's return to tariffs isn't just a domestic move, it's a message to the world: buy American or pay the price. But here's the problem: tariffs don't work in a vacuum. They raise input costs, reduce competitiveness, and spark retaliation. In short, they backfire. In May, US exports plunged 5.2%. That's not a dip. That's a gut punch. Industrial supplies, agricultural shipments, and even crude oil exports all down. And the trade deficit? It's widening again. Why? Because tariffs aren't just raising costs for foreign importers. They're hurting American manufacturers too. Companies like Walmart are expected to absorb the extra costs, but let's be honest, those price hikes get passed on to you, the consumer. Retail sales tell the real story. In April, revised figures showed a 0.1% decline. In June, the preliminary numbers dropped again, this time by 0.9%. That's nearly a full percent lost in a consumption-driven economy, and 70% of US GDP relies on consumer spending. If Americans can't afford to buy, companies can't afford to grow, and the Fed can't print, its way out quantitative easing is politically toxic right now, and inflation is still too high to justify loose money. China's financial escape plan. Let's talk strategy. China isn't just dumping treasuries or de-dollarizing by accident. They've studied the system, mapped its weaknesses, and now they're building an escape hatch made of gold. Why gold? Because gold is outside US jurisdiction. You can't freeze it, you can't sanction it, you can't debase it with a printer, and China is leading the world in both gold production and consumption. They've been quietly accumulating reserves for over a decade. Now they're giving the world a new option: settle trade in physical gold, outside of Western oversight, in a global financial hub like Hong Kong. Middle Eastern nations are already paying attention, sanctioned regimes too. After the US froze Russia's central bank assets in 2022, confidence in dollar safety collapsed. Why would countries trust the US not to weaponize their own reserves next? This is why China's gold move is more than a financial product. It's an insurance policy against American financial power. The sanctions backfire. America's sanctions playbook has been effective until now. In 2022, the Biden administration seized over $300 billion in Russian assets. That sent a message. But it wasn't just to Moscow. It was to Beijing, Tehran, Riyadh, and everyone else. Your money isn't safe in US institutions. Suddenly, central banks began reducing their exposure to US assets. China, in particular, accelerated its sell-off of treasuries, redirecting capital into gold, commodities, and Belt and Road infrastructure deals. They're building a parallel system, and they're not alone. Iran's been using yuan-based trade to avoid sanctions. Even Saudi Arabia, America's longtime energy ally, has shown interest in settling oil trades in currencies other than the dollar. For decades, the petrodollar system was sacrosanct. Today, it's cracking. The US economy under pressure. The data is grim. In the first quarter of 2025, the US economy shrank by 0.5%, according to revised GDP numbers. That's not just a technical recession, it's the steepest quarterly decline in modern US history outside of pandemic shocks. Inflation is still persistent, yet growth is negative. That's the worst-case scenario, stagflation. What's causing it? The toxic combination of tariffs, weak consumer spending, and collapsing exports. Businesses are paying more, selling less, and watching demand dry up. Interest rates remain too high to spark growth, yet too low to tame inflation. The Fed is trapped. Trump's strategy to solve this? Cut rates fast and hard, even if that means replacing Powell. But here's the danger. Rate cuts weaken the dollar even further, especially when foreign capital is already fleeing to safer, more stable alternatives like gold. The dollar in decline. There have been dollar dips before, post-2008, during the COVID stimulus era. But this time, the structural weaknesses are exposed. In 2008, the Fed printed hundreds of billions. In 2020, they added nearly $5 trillion to the balance sheet. That money devalued the dollar, yes, but back then, there were no alternatives. Now, there are. China's expanding its cross-border interbank payment system, a competitor to SWIFT. They're making it easier for international investors to access Chinese stocks and bonds in yuan, and in many cases, with gold as collateral or hedge. Countries don't need to stockpile dollars anymore to engage in global trade. They can use the yuan or settle in gold. And the data proves the shift. 52% of China's cross-border transactions are now in yuan. Only 5% are in other non-dollar currencies. Meanwhile, dollar settlement in global trade has fallen below 45%, an unprecedented decline. The political stakes. Trump knows what's at stake. His campaign isn't just about borders or immigration. It's about preventing a dollar collapse. That's why he's betting everything on renegotiating trade, cutting rates, and consolidating monetary power. He wants a Fed that listens, that cuts. That helps the US flood markets with cheap credit to stimulate exports and spending. But if the Fed cuts while inflation remains sticky, foreign investors will run, treasury yields will spike, the cost of borrowing will rise even as the dollar weakens, and the vicious cycle begins. Trump's also escalating pressure on trade partners. "We're not going to make deals with everybody," he said recently. "Some will just send a letter 25%, 35%, 45% tariffs." It's bold, but it risks further isolating the US economy from global markets just as consumer strength is fading. Global power realignment. This isn't just about inflation or gold, it's about influence. For decades, the US used the dollar as a lever of control, setting global rates, imposing sanctions, funding wars, managing alliances. But as the dollar weakens, so does America's grip. China sees the opening. They're filling trade gaps, brokering deals, offering credit, often in yuan. Their Belt and Road Initiative isn't just about infrastructure. It's about forging new financial allegiances. And now, with physical gold contracts in Hong Kong, China is offering the world a way out of the dollar trap. You can trade, settle, invest outside of US reach. The real risk? It's not that the dollar disappears tomorrow. It's that over the next 5, 10, 20 years, countries stop needing it, slowly, systematically, irreversibly. Foreign investors are losing patience with Uncle Sam. Let's break something important down. In the past, the world looked at America's debt and shrugged. Uncle Sam was still the safest bet around, but not anymore. Foreign investors now hold more than $8.5 trillion of US government debt that's over a quarter of the entire market, and the confidence they once had, it's starting to crack. Here's the clue. Normally, when US bond yields rise, meaning the government is offering better returns, investors come running. But this time, something strange is happening. Yields are rising, but the dollar isn't. That tells us something. Global investors are no longer willing to just look past Washington's out-of-control spending. They're demanding higher returns because the risk of lending to the US has gone up. And if those higher yields don't come fast enough, these investors might start dumping treasuries. And when they do, they'll take the dollar down with them. The risk loop. Higher rates, bigger problems. Here's where the cycle gets dangerous. Rising interest rates aren't just about making bonds more attractive. They make US debt more expensive. Right now, America is already paying nearly $1 trillion a year just in interest payments. And that's growing. As the US borrows more, investors get nervous, so they demand even higher interest rates. That, in turn, increases the debt burden further. You see the spiral? And if foreign buyers step back or worse, sell off US bonds, then the government might be forced to raise rates even more just to attract them again. That's how debt snowballs, and that's how you get a real currency crisis. Is a dollar collapse even possible? It's the question on everyone's mind. Can the US dollar lose its crown? Well, it's still the world's reserve currency, and for now, that matters. Most international trade is still settled in dollars. The US still has the deepest, most liquid capital markets in the world, and global investors need a place to park their money. But the warning signs are everywhere. Even if there's no outright crash, the long-term erosion of trust in the dollar is real, and it's happening right now. And guess who's watching this shift closely? China tightens its grip. Recently, the People's Bank of China made a quiet but powerful move. They told China's state banks to stop buying US dollars for their own accounts. At the same time, they ramped up scrutiny of dollar buying orders from clients. Translation: Beijing is turning off the dollar tap. And on top of that, China's central bank ordered its biggest banks to sell dollars and buy yuan. Not in secret, out in the open, just to stop the yuan from sliding too far. You might think, wouldn't a weaker yuan help their exports? Yes, but China is choosing financial stability over currency war for now. What they won't do is let Trump's tariffs wreck their long-term strategy. Trump's tariff war just got hotter. Starting this week, Trump hiked the total tariff level against Chinese goods to 104%. Yes, you heard that right, over 100% in total levies. China responded with defiance. Officials said they would fight to the end, refusing to be blackmailed by Washington. Behind the scenes, China is using 3 powerful tools to fight back: currency stabilization by force, tax rebates and subsidies to cushion exporters, massive diversification of trade and finance away from the US, and one more powerful move, pulling US dollar dependency out of their system: the rise of China's SIP system. 10 years ago, China quietly launched SIP's cross-border international payment system. Think of it as an alternative to SWIFT, the Western-controlled network that moves money around the globe. At first it was small, but now it's spreading fast through Asia, Africa, the Middle East, and even into Europe. CPS allows foreign banks to do business with China in yuan, not dollars. And for countries that don't want US sanctions to hang over their financial systems, that's a very attractive option. As tensions rise with the US, China is pitching CIPS as the future, and some nations are buying in. Opening China's financial gates. For decades, the big knock against the yuan was capital control. You couldn't freely move money in and out of China, which made the currency unreliable for reserves. That's starting to change. At the World Economic Forum's Summer Davos in Tianjin, Chinese Premier Li Qiang unveiled a new direction: wider financial access, more openness, and fewer capital restrictions. He said China wants to become a mega-sized consumer powerhouse, attracting foreign capital while keeping manufacturing leadership. It's a clear pitch to investors. Bring your money here, we'll protect it, and you won't need dollars. Multipolar currencies are coming. The governor of China's central bank, Pan Gongsheng, recently made a bold claim. He called for a future where multiple sovereign currencies compete, not just the dollar dominating all. This isn't just a Chinese fantasy. Even European Central Bank President Christine Lagarde said the euro could take on a global role. She called it a global euro moment. It's part of a bigger strategy to de-dollarize the world, slowly, methodically, but very deliberately. And when two of the world's biggest economies, China and the EU, start echoing the same message, markets listen. Trade war meets investment chaos. Meanwhile, back on the business front, companies around the world are frozen in place. At the WEF meeting, Hong Kong investors said they can't even price a new factory anymore. The reason? No one knows what Trump might do in 3 years. Will tariffs go up again? Will China be cut off from US tech? Will sanctions hit next? That's not a risk, that's uncertainty. And for global capital, uncertainty is poison. Even before Trump's renewed tariff war, global investment was already falling. In 2024, foreign direct investment dropped by 11.5%. And now, it's worse. Europe sounds the alarm. Italy's Deputy Minister for Enterprise didn't hold back. He said the US is using tariffs not just to compete, but to plug its own debt holes. His words were sharp. Tariffs are being used as a source of income to cover massive US debt. And the warning was even clearer. When goods stop crossing borders, armies might. Europe doesn't want a world torn apart by economic nationalism, but it's watching the US spiral into deeper and deeper debt while pushing aggressive trade tactics. If Europe starts choosing yuan over dollars, that would change everything. The math behind Trump's budget gamble. Let's bring it back to America's balance sheet. Trump's big, beautiful budget is fueling even more concern. According to the Congressional Budget Office, the House version would add $2.4 trillion to US debt by 2034. The White House says growth will offset it. Critics say that's wishful thinking. And on the Republican side, some want even deeper cuts, especially to entitlement spending. Why? Because they see what's coming. Senator Ron Johnson put it plainly, what we're trying to avoid is global creditors looking at the United States and saying, you're a credit risk. But if the world already sees that risk coming, then the dollar slide has already begun. Is the yuan ready to replace the dollar? Let's be real. The yuan isn't ready to fully dethrone the dollar, not yet. Why? Because China still controls too much. It's not a free market economy. Investors can't fully trust that their money won't be locked up or redirected. Even China's own advisors admit this. Morgan Stanley analysts recently said the yuan's global potential depends on two things: a strong economy and more convertibility. That means China needs to allow money to flow in and out without massive restrictions, and that's still a work in progress. But make no mistake, the ambition is clear, the goal is set, and Beijing is moving step by step to get there. From dollar dependence to diversification. In the end, here's the truth. The US dollar isn't crashing overnight, but it is eroding. Foreign investors are diversifying. China is cutting dollar links. Europe is talking reserve alternatives. And the US is pushing policies that scare off long-term confidence. The collapse won't be dramatic. It'll be slow, gradual, but unmistakable. And when the tipping point comes, it won't be because of a single decision, but 1,000 small ones from governments, banks, and investors who quietly decided they've had enough. The shift is here. What we're witnessing is not a theory. It's a shift visible, measurable, and strategic. Trump's aggressive Fed strategy, his tariff wars, and China's methodical financial moves are triggering the most serious challenge to dollar dominance since Bretton Woods. The US is playing offense with military might and monetary policy. China is playing defense with gold and global partnerships. The battleground is financial, and the stakes are massive. Will Trump's strategies revive the dollar or hasten its decline? Can China's gold gambit really reshape the global economy? Let us know in the comments. Drop your thoughts, and let's get the conversation going. If you found this breakdown sharp, strategic, and honest, smash the like button, subscribe, and ring the bell. Stay alert, stay informed, because the next chapter, it's already being written.